And let's bring in our first panel now, which is Barry Knapp, the Director of Research at Ironsides Macro, and Tom Lee, Fundstrat Global Advisors Managing Partner. Welcome to you both. Tom, you're more, I don't want to make it sound like you have a point of view other than you're expecting a more hawkish Fed, and Barry, you're expecting one that's a little bit more dovish. So Tom, you're more in line with consensus right now. What would that look like, and why are you still bullish on stock prices?
Well, I think precisely because our clients are expecting a hawkish cut. So exactly as Steve laid out, Fed does a cut, but future cuts are uncertain, not even maybe until June. Now, because that's the base case, then if that's what happens, of course, markets have already been bracing for that, and they've been bracing for it since October. And of course, there's a chance that it's a dovish cut, which would be bullish as well. And then I think
what to you would be a dovish cut? So, are there projections? Are there dots?
Yes,
there is. So we'll know right away if they come out and those projections show that they're expecting more rate cuts next year. Then you're saying we might only get one more in the summer.
That's right, and it could also be interpreted dovishly if they start acknowledging the balance of risks are shifting, so that then markets can realize the Fed is now acknowledging there's some underlying fragility of the economy, and of course now QE. Because QT is ending, it's essentially not QT, which is QE. And there's, of course, the chance that there's something positive the Fed has to say. So I think it is a hawkish cut, but actually I think market reaction's positive.
And there's so much more you're queuing up here we're going to get into. But on a top level, why isn't it a bigger roadblock for markets, Tom? You could look at this and just say, well, we're already basically at all-time highs. Look at the Russells and so forth. And Powell's been known to not have a very favorable reaction to his commentary, and he's only got a few meetings left, so maybe he's even more hawkish than usual. I don't know. Why don't you think that's a bigger risk? Whether it's, I'm not just myopically even talking about this afternoon, but kind of setting the tone into year end and then into next year.
Yeah. I think part of it is just the market's now adjusted to the idea that the Fed is institutionally slightly hawkish. Now, part of it may be because that there could be undue pressure coming from outside the Fed, and the institution wants to protect its integrity, and that comes across as hawkish. But that dynamic is something the markets have been bracing for, and they've reacted negatively to it, like in October they did. And so I think because of that, that's what people are building into this December meeting, which is why it could be a surprise.
It's like when Apple always gives cautious guidance. The stock always sells off after earnings, and then it does fine again. And they also, of course, have the post-COVID period to react to, where you know that someone like Powell, who's about to leave, is going to want to say, I didn't reopen the door to inflation. Right?
Yeah, that's right.
For that
Protect
institutional
his legacy.
Exactly. So, Barry, all of that said and done, there are still lots of people starting to talk about this quantitative easing issue. So it's a little bit confusing when you have. Are we to view that even as economic policy making, or is that something completely different that just has to do with the plumbing of the financial system?
So for 3 years, you and I have been talking about the Fed eased primarily using their balance sheet, but tightened using only one of three channels that they have, which is they've just been draining reserves from the system. And so that's the plumbing issue, which is getting tight. But the much more important and impactful part of QE is when they're buying Treasury notes and mortgage-backed securities. That lowers long-term rates, which is what really influences equity prices and other risky assets. And they suppress volatility by buying mortgage-backed securities because of prepay.